Meet Kenith. He runs a flower shop on a very busy street. Business is good, but he'd like to do better. Kenith is smart. He notices that the business is really good on certain days like Valentine's Day. In fact, the business soars on certain holidays that demand outpaces supply. To get ahead of the problem, Kenith decided to increase his inventory. He asked his supplier to increase his daily inventory by 20%, hoping customers would come, but they don't. Lying there unsold, Ken's flowers withered away. Kenith took a hit in the next week. Kenith wondered, how do I accurately predict my future sales? Seeking better control over his inventory and sales, Kenith hired the services of a professional firm. The financial modelers analyzed Kenith's historical data, his sales receipts and balance sheets from the last 2 years. They did what-if analysis to account for various scenarios and events. They then built a predictive model that would take the guesswork out and help make better decisions based on forecasts and assumptions. A financial model is a mathematical model designed to represent a simplified version of performance of a financial asset or portfolio of a business, project, or any other investment. Based on the models, Kenith was accurately able to predict the demand and stock his inventory accordingly. Sales were up by a whopping 20%. Numbers at the heart of business decisions, and financial models help owners like Ken make better decisions.
Forecasting using the bottom-up approach has the strength of forcing attention to specific categories necessary to plan and manage the activities of individual reporting units, departments, and plants. In the previous session, we discussed the basics of a bottom-up approach to derive the future financial performance for the company. Further, we learnt modeling revenues. It is important to understand all of the considerations in building the model as accurately as possible. However, building a complete financial model for a company does not end there. The projected balance sheet must also be built, and all the financial statements must be integrated correctly. Now that we have an understanding of modeling revenue, we will learn how to model expenses and balance sheet items. Previously, you have learnt about modeling revenues for the bottom-up approach of modeling. In this session, you will learn about modeling the other half of the income statement, that is costs, and modeling several balance sheet items which include capital expenditure and depreciation, working capital items which include receivables, inventory and payables, understand the concept of funding requirement and model debt. Let's begin with the types of costs. There are 3 types of costs. These are fixed costs, semi-variable costs and variable costs. We will now look at each of them separately. What are fixed costs? Fixed costs refer to costs that have to be paid by the business irrespective of any business activity. Examples include rent and insurance. They tend to be time related and are often referred to as overhead costs. For example, in a bakery, the monthly rent for the baking facilities, the monthly payments for the security system, and a basic phone line are fixed costs as they do not change according to how much bread the bakery produces and sells. A few more points to remember on fixed costs. Your forecast for fixed costs may change on the basis of certain known future events. Example, if new premises are to be leased on different terms. A good way to remember this is that any per unit fixed costs are based on installed capacity and not on utilized capacity, which iterates that these costs need to be incurred irrespective of utilized capacity or level of business activity. These costs are usually a function of prior period costs with some escalation applied to it. The second type of cost is semi-variable cost, which is also known as semi-fixed or mixed cost. The costs in this case may be fixed up to a certain target level of performance and variable thereafter. A classic example of semi-variable costs is labor, since the existing labor force can produce up to a certain level of output at no incremental cost. Any further increase in output would have to be supplemented by some additional manpower per unit of incremental output. Similarly, fuel cost may also be semi-variable. A certain minimum quantity of fuel may be available at a fixed rate, but if anything more than that quantity is required, it may have to be sourced at a variable rate. These costs are partially linked to prior period costs with escalation and partially to the variable parameter to which they are linked, such as output per labor unit or fuel requirement per unit of output. Finally, variable costs are costs that change in proportion to the good or service that a business produces. They are entirely variable based on production or output or sales. Example, packaging cost, marketing cost, commissions, freight, transportation cost, etc. These are usually modeled simply as a percentage of sales or a percentage of some other cost if they are interlinked. For example, packaging cost may be linked to production cost or revenues, whereas marketing costs are almost always linked to revenues. The three types of costs are forecast using a combination of various elements that we will now discuss. First, input prices. Input prices are the prices paid to the providers of inputs. Inputs are the basic raw materials required to manufacture products or provide services. For example, coal for a thermal power plant is an input, and its price depends on prevalent coal prices, which are regulated. So the fuel cost for producing power is dependent on the coal prices. To determine the price of coal, you need to analyze the quantity of coal required to achieve desired level of production. Hence, modeling this cost would involve cost volume analysis, which is similar to price volume analysis done for revenues. Here, you estimate the quantity of an input required per unit of output, which would then give you the total required quantity of inputs per period. This, when multiplied by the input price, would give you the total input cost or raw material cost. After estimating the cost of materials, it is time to understand labor cost. The cost of labor is the sum of all wages or salaries paid to employees, as well as the cost of employee benefits and payroll taxes paid by an employer. The labor cost depends on the number of employees or manpower, the rate per employee, and the projected increase in both number of employees as well as the rate of pay. If no increase in labor is anticipated throughout the business plan period, it is not uncommon to simply escalate historical labor cost on a year-on-year basis considering normal inflation. Costs may be estimated as a percentage of other costs or a percentage of revenues. Other overheads such as packaging costs, marketing costs, and admin overheads are usually simply modeled as a percentage of revenues. Often, costs may be simply modeled on the basis of analysis of costs per unit. It is important to remember here that some items of cost would be represented as cost per unit of output, that is, cost per unit of production, such as raw material cost, whereas some costs may be represented as costs per unit sold, such as marketing cost. These may be analyzed over the historical period and then simply escalated or modified suitably during the forecast period. This is done in the absence of detailed information such as raw material requirement or size of the labor force, which makes calculation of detailed underlying inputs very arbitrary. Another method of estimating cost is activity-based costing. The essence of activity-based costing lies in breaking cost items by activity rather than their traditional heads. Examples include cost per unit for each process involved in manufacturing, cost per customer for each component of service rendered. If a manufacturing process has several stages or activities, as it usually does, the cost per unit for each activity is estimated and shown directly instead of breaking it down into elements like fuel, labor cost, etc. So let's get into further details of our example. In the grinding unit, costs would be per unit of limestone extracted. For the clinker unit, it would be based on processing cost per unit of clinker produced, and in the cement mill, it would be based on costs per unit of cement produced. Thereafter, marketing and other overheads or selling costs could be based on units of cement sold. Since fuel, labor, etc. would be used at each stage, breaking down the costs by these heads would give the combined fuel cost for all processes, whereas breaking it by activity gives the combined cost of all kinds, fuel, labor, production overheads for each activity or process. Lastly, transportation costs need to be built in. For domestic sourcing, transportation costs may be on per unit basis or per ton or unit of weight. For imports, you would need to consider the freight component in addition to ground transportation. Freight costs are represented as either cost insurance and freight or CIF or free on board, that is FOB. In cost insurance and freight or CIF for short, the seller is required to pay all the costs including freight and insurance to bring the goods to the port of destination, that is the buyer's port, and delivered to the buyer. From a modeling perspective, this means the raw material cost would include freight charges and only ground transportation needs to be separately considered. However, under free on board or FOB for short, the risk is transferred to the buyer once the goods are loaded on the ship and the raw material cost per se is excluding freight. This means when modeling these costs, freight and ground transportation need to be modeled separately. Having gone through the methods of forecasting revenues and costs, we now move on to some crucial balance sheet items, starting with the capital expenditures, commonly known as CapEx. CapEx is an expense where the benefit of the expense continues over a long period rather than being exhausted in a short period. It results in the creation of an asset in the balance sheet and addition of physical assets in the company in the form of buildings, machinery, equipment, furniture, even items of regular use such as company vehicles, computers, coffee machines. The cost for these items are usually lump sum that is incurred in a single period. This results in a cash outflow and creates a fixed asset in the books. Now there are two types of capex, replacement capex and maintenance capex. Replacement capex is time based, that is, it depends on the life of the asset. If an asset has a life of 5 years, it has to be replaced after 5 years because it will not be of any use thereafter. The replacement of that asset would be defined as a replacement capex. This is modeled based on the replacement life of an asset, which is based on extensive data for specific assets. Inputs include age profile, mean and standard deviation, and unit replacement cost. On the other hand, maintenance capex relates to normal wear and tear of an asset. In order for the asset to perform to acceptable levels throughout its life, it needs to be maintained well. This could be something like oiling of machinery parts, painting of the office building, servicing of air conditioners or vehicles, and such other routine expenses which need to be incurred periodically to keep the asset in working condition. It is usually modeled as a percentage of the asset block or sometimes even as a percentage of manufacturing costs or revenues. The logic of considering it as a percentage of revenues is that for every rupee spent on maintaining the asset, X amount of revenue can be generated. A unit rate reflecting the typical cost of replacing that asset is applied to each quantity of asset to derive an overall forecast of annual reinvestment expenditure. Infrastructure projects like building of roads and bridges involve something known as major maintenance expenditure. This is based on a certain large amount of expense to be incurred periodically, say every 5 years or every 7 years. This would also consider some normal escalation. An example of major maintenance expense is resurfacing the tar on roads to level it. This is not routine maintenance because such major maintenance activity would increase the life of the road and the road may not be usable without such an exercise. So the important thing to remember is that it is routine maintenance if it's just to maintain the operations of the asset, but major maintenance if it results in increasing the asset life. For such major maintenance, usually a major maintenance reserve or MMR is required to be maintained. This is usually done by provisioning some amount every year so that the requisite amount is available in the year of incurrence. For instance, if major maintenance is to be incurred in year 5, 1/5 of the amount required would be set aside in each of the 5 years preceding such expense so that in year 5, this amount is readily available to be incurred. There is also some interest that may be earned on such provisions which are set aside and usually parked in liquid investments. In addition to these, any specific plant capacity expansion also needs to be considered in the forecasts. There are two ways of doing this: forecasting production volumes based on plant capacity additions or vice versa. This means that if production volumes have been forecast considering some capacity addition, this capacity addition must reflect in the capex forecast. Similarly, if any capex is being projected, it must result in some incremental revenue. Let us consider an example of capital expenditure per bed in hospitals. If you have projected an increase in number of patients while forecasting revenues, you need to consider the corresponding capex here. You might have simply grown the existing hospital revenues. If you had not considered capital expenditure, then you need to go back and change your revenue projections to incorporate the effect of such capacity additions in order for the model to be realistic. Coming to depreciation, it refers to a reduction in the value of an asset over time due to wear and tear. The idea is to provide some amount every year so that by the end of the asset life, you are able to set aside enough funds to replace it. Depreciation is a non-cash item, that is, it does not affect the cash flows of the entity, it only affects profits. Net block of assets is nothing but gross block minus cumulative depreciation on existing assets. This is known as accumulated depreciation in accounting parlance. There are primarily 4 methods used to calculate depreciation. They are the straight line method, written down value method, units of production method, depreciation based on depletion or remaining useful life, and a related concept is that of the asset restoration reserve. Let's learn more about each of these. First, we have the straight line method. Straight line depreciation is the default method used to gradually reduce the carrying amount of a fixed asset over its useful life. This method considers some residual or scrap value of the asset. The remaining value is written off systematically and equally over the life of the asset. For example, let's say the cost of an asset is Rs 100. The estimated useful life is 10 years. The scrap value at the end of its useful life is Rs 5. Rs 95 is the depreciable value of the asset, which is derived by reducing the scrap value from its actual cost. This amount is equally spread over 10 years and is then shown in the profit and loss account as depreciation. In this case, the depreciation would be 1/10 of 95, that is Rs 9.5 every year. The straight line method calculates depreciation on the gross value of assets. Next, we have the written down value method. Under the written down value method, depreciation is charged on the net book value, also known as the written down value of the asset. The net book value, as explained earlier, is the gross value minus all the depreciation charged till date. In this case, if the gross cost is Rs 100 and scrap value is Rs 5, then Rs 95 would be depreciated at say 10% over 10 years. The depreciation in year 1 would be 95 into 10%, that is Rs 9.5. At the end of year 1, the closing balance of the asset, that is its net book value, is 95 minus 9.5, that is Rs 86.5. This is similar to the straight line method. However, in year 2, depreciation under the WDV method at 10% would be charged on 86.5 and not on 95. So the depreciation for year 2 would be 8.65 and the net book value at the end of year 2 would be Rs 77.85. So on and so forth till year 10. Under the straight line method in year 2, depreciation would still be Rs 9.5 and hence the net book value would be Rs 76. The calculations for depreciation are done on depreciable value alone, that is excluding the scrap value, which would still form part of the asset block. As the book value in the WDV method keeps on reducing by the annual charge of depreciation, this method is also known as the reducing balance method. Further, in the SLM, the written down value of the asset at the end of year 10 would be equal to its scrap value. If the scrap value is 0, then at the end of the asset life, its net book value will be reduced to 0. Another method for calculating depreciation is the units of production method. This is generally applied to property that is not in continuous use. The units of production method is useful when the property's value is more closely related to the number of units it produces than the number of years it is in use. So if the capacity of a machine is 1 million units throughout its useful life, then the depreciation for each year would be number of units produced in that year divided by 1 million, which represents the proportion of the asset that is used in the year. The 1 million units may be produced by an entity in 1 year or 10 years or 25 years. Basically, the life of the asset is not time determined but production determined. In such a case, the units of production method is used. You can also calculate depreciation based on depletion, which is linked to the remaining useful life. This is usually used in the mining sector. Depletion is nothing but a periodic charge to expense for the use of natural resources. Thus, it is used in situations where a company has recorded an asset for such items as oil reserves, coal deposits, etc. In this case, the total value of the asset is depreciated by dividing it each year by the number of useful years left. So, for a mine with a life of 30 years and with initial cost of say 30 million, hypothetically, in the first year, depletion would be 30 million divided by 30, that is 1 million. So, the WDV at the end of year 1 would be 29 million. In year 2, the WDV would be depleted over 29 years and not 30 years, since the cost has to be recovered over the remaining useful life of the mine, which is 29 years and not 30 years. The method is not used for normal manufacturing or service sectors and is specific to environment related activities. A reserve requirement related to environmental activities is an asset retirement obligation or an asset restoration reserve. In some ways, this is similar to depreciation. For instance, let's take the example of a garbage landfill. The government issues the contract to a company which has to operate it for 10 years. At the end of 10 years, it has to restore it and return it to the government in the same physical condition that they received it. In such a case, the company would start providing for the asset restoration cost from year 1 itself. This would be a charge to the P&L and create a liability in the balance sheet, which needs to be unwound in the last year of the contract. We've so far looked at fixed assets or fixed capital. Now it's time to move on to working capital, starting with receivables. Receivables are the amount of money that customers currently owe to the company for goods or services that were purchased on credit. Many companies offer credit programs to customers who frequent the business or regularly order products. The purpose of a credit program is to encourage customers to shop and give them incentives to purchase goods even if they don't currently have cash to pay for them. Receivables are usually evaluated by using the metric number of days sales. Forecasting receivables takes into account number of days of sales. It also considers the current credit terms offered to customers and any expected improvement in collection cycle going forward. Forecasting receivables also needs to consider any existing receivables that may never be recovered. This is done by providing for bad debts or writing off some receivables. Next, we will learn about inventory. Inventory refers to the materials that a business holds for the purpose of sale. It includes raw materials, finished goods, work in progress, capital work in progress, and goods in transit. Raw materials are based on the number of days of cost of goods sold, while goods in transit are usually represented as a percentage of revenues or number of days of sales, similar to finished goods inventory. Work in progress or capital work in progress refers to various things. In the real estate sector, it includes assets under construction held for sale. In the infrastructure sector, it refers to assets under development pending capitalization. In general, work in progress for the manufacturing sector refers to the number of days of manufacturing cost. Finally, finished goods are usually evaluated based on the number of days of sales. Sometimes, inventory of finished goods is simply calculated by looking at the unsold goods, which is nothing but production volumes minus sales volumes. These need to be reflected on the basis of costs incurred to produce them. Another key item under working capital is payables. Payables refer to the money owed by a business to its suppliers. It is shown as a liability on the balance sheet. Payables consist of creditors for COGS or manufacturing cost, which are measured in terms of number of days of COGS. OPEX creditors measured as number of days of operating expenditure, and CAPEX creditors measured as a percentage of CAPEX incurred during the year or number of days of CAPEX. We also need to consider the current terms offered by suppliers and expected improvement or deterioration in these terms, if any. The last topic we are going to discuss in forecasting pertains to funding requirements. Funding requirement refers to the need for cash recognized and provided for through an allocation of funds. Funds could be raised as debt or equity. They could be raised to fund capital expansion or working capital expenditure, and they could be long-term or short-term in nature. A very important metric to evaluate performance as well as model funding is the debt-equity ratio. The debt-equity ratio is a ratio used to measure a company's financial leverage. It is calculated by dividing a company's total debt and outside liabilities by its equity, which is the total amount contributed by shareholders. In forecasting future funding plans, one needs to consider whether the existing capital structure, that is the debt-equity ratio, will remain same or change. A company may have 50% debt in its books, but if it tries to raise more debt for a new project under evaluation, it is possible that the project can only be funded by debt up to 40%. This depends on the ability of the company to raise new debt and negotiate terms. Such known changes and credit conditions need to be taken into account while modeling funding. Any funding gap should also be evaluated to assess how it is proposed to be raised. For example, if it is anticipated that only 40% of the project cost can be raised through outside debt, and if the promoters have the ability to infuse only 40% funds, then adequate arrangements need to be made for the balance 20%, whether by bringing in a new promoter or by approaching new investors, or if the promoters have the ability, then by bringing some short-term loan as viability gap funding arrangement. In relation to debt, modeling equity is fairly straightforward since there is no repayment or defined structure to be modeled. Equity only earns dividends based on available profits and cash and some regulatory requirements depending on which country or entity is based in. On the other side, modeling debt can be quite challenging. There are a lot of terms related to debt that need to be understood and adequately factored in the model. We'll look at a few here. Moratorium. It refers to a period during which the company would not be required to make any principal repayments. It will still have to pay or accrue interest though. Moratorium is usually provided by lenders for projects which have long gestation periods since they take a while to start generating revenues, and hence the borrower is given some benefit to commence repayment after 1 or 2 years. Another key term is periodicity of repayments. The repayment schedule of the debt is important. Repayment could be quarterly, semi-annual or annual. Quarterly repayments refer to payments due 4 times each year or at every quarter, which could be at the beginning or end of each quarter. Semi-annual payments refer to payments twice a year or once in 6 months. Annual repayments refer to payments made once a year. Sometimes repayments may be annual, but interest may be compounded quarterly. It is important to note such terms in the loan agreement when trying to model debt. Even if this is for future debt, by looking at the past debt agreements of the company, it is possible to reasonably anticipate the terms that would be available to the company on new debt. On infrastructure projects, interest rates usually differ during construction period versus operations period. Usually, the rate of interest during the construction period is marginally lower than that in the operations period. It is important to note that interest paid during construction is allowed to be capitalized along with the asset for which the loan is raised. This approach is allowed under most accounting norms, whether following accounting standards in India or IFRS or US GAAP. The gross block of such infrastructure asset therefore would include the interest during construction. Let's look at some characteristics related to interest computation. Interest may be calculated on average balance of the loan, which is opening balance for the period plus closing balance for the period divided by 2, or on the opening balance plus additions during the year. Usually, average balance is recommended. Interest can be accrued over a period and paid over a different period, or the two may be simultaneous. This means interest may be accrued quarterly and paid as accrued, that is paid in the same quarter, which means the P&L entry and cash outflow would occur in the same period. Alternatively, it may be accrued quarterly and paid annually. Although this is not a common arrangement, we have seen it in some cases. Usually, interest is paid as it is accrued. Another important term is debt covenants. These refer to various conditions related to the debt. Some of these need to be met either at the time of drawing the loan, while others need to be maintained throughout the tenure of the loan. We will look at debt service coverage ratio, interest coverage ratio, and debt service reserve account. The debt service coverage ratio, or DSCR, also known as debt coverage ratio or DCR, is the ratio of cash available for debt servicing to interest, principal and lease payments. The cash available for debt servicing, known as CFADs, is all operating and investing cash flows plus any financing cash flows before lease payments, payment of interest or principal repayment. CFADs divided by the interest plus principal repayment plus lease payments due for a period gives the debt coverage ratio or DSCR for that period. Interest coverage ratio. The interest coverage ratio is used to determine how easily a company can pay interest expenses on outstanding debt. The ratio is calculated by dividing a company's earnings before interest and tax, that is the EBIT, by the company's interest expenses for the same period. Finally, the debt service reserve account. Debt service reserve account or DSRA, commonly known as DSRA, is a key component in almost every project finance term sheet and financial model. The primary purpose of the DSRA is to protect a lender against unexpected volatility or interruption in the cash flow available to service the debt. This requires a borrowing company to maintain at the end of every period the amount of cash required to service interest and principal repayment of a defined subsequent period. For instance, a lender may require that at the end of every year, the company must maintain at least 2 quarters worth of interest and principal repayments due. Finally, let's study repayment profiles. There are 4 primary kinds of repayment profiles that can be built in financial models when modeling debt. They are manual profile, equated repayment, bullet repayment, and structured repayment. First is the manual profile, which requires a manual percentage input of principal repayment per period. The total of these percentage inputs must add up to 100% eventually. It's always a good idea to check this by setting up a debt drawn down is equal to debt repaid check. Equated repayments is constant over a defined period, whether a quarter or a year. This payment may either represent a constant percentage of principal alone or appropriate a certain part to interest and some portion to loan. For example, a 10% loan of rupees 100, let's say the EMI over 5 years is rupees 20. Now there could be 2 ways this rupees 20 could be treated. Rupees 20 may be entirely appropriated to the rupees 100 principal repayment, so interest would have to be considered separately. So in this case, cash outflow would be rupees 20 EMI, which is for the principal, and rupees 10, that is 10% of 100, which is the interest, that is total rupees 30. This is a simplistic structure. In the next period, the EMI would be rupees 20 and interest would be 10% of rupees 80, since 20 was repaid earlier, that is rupees 28. The total cash outflow would be rupees 28. The alternative approach is the EMI structure adopted by banks. EMI stands for equated monthly installment. We will look at an example of equated annual installment. Here, the equated installment of rupees 20 is appropriated towards principal and repayment. So, in year 1, out of the rupees 20 EMI, rupees 10, that is 10% of 100, is interest and the balance rupees 10 is the principal repayment. There is no further cash outflow since interest forms part of this amount. So, the total cash outflow is rupees 20. In year 2, out of the installment of rupees 20, rupees 9 is the interest, that is 10% of the balance rupees 90, since 10 represented principal repayment in the previous year, and rupees 11 represents the principal repayment of the current year. The total cash outflow is again only rupees 20. In this manner, at the end of year 5, total rupees 100 worth of principal repayment is recovered. Another repayment profile is the bullet repayment. This is simply repayment at the end of the loan tenure. Interest could either be paid periodically or accrued, compounded and paid together with the principal repayment at the end. Lastly, repayments could be structured based on available cash flows and covenants to be maintained. For example, the lender may stipulate that periodic repayment should be such that the DSCR does not fall before 1.2x of cash flows. This requires effective and iterative modeling to ensure covenants are met and interest and principal payments are appropriately captured. One last point to be kept in mind regarding debt is if you are modeling an existing company or project and not a greenfield or completely new one, there may already be some existing debt in the books. You would need to assess the aging of this debt. That is, if the loan originally had a tenure of 10 years and 3 years have already lapsed, then remaining loan life is 7 years. You would then need to plot the repayment profile of this existing debt. Any new debt should be modeled keeping existing debt in mind for calculating the debt equity ratio and other key metrics. That's it for now. We hope you found this session on the bottom-up approach insightful.